Welcome to Trading Nation. I'm Sarah Eisen. Let's take a look at energy stocks. The XLE Energy ETF rallying on Tuesday, now tracking for its best month since last September. Energy is the best performing S&P sector this month. So is there more room to run? Let's bring in the Trading Nation team to discuss. Matt Maley with Miller Tabak. Larry McDonald is with the Bear Traps report. Gentlemen, interesting to see energy take the lead here. Larry, you're bullish. Why?
Well, we have a late cycle, obviously, economy and global growth story. But in particular, you've got an M&A cycle that, because of cheap financing and rising rates, you've got a lot of companies and mergers that are, I think, in the works in this space that there's such cheap valuations with cheap financing. We feel you're going to have a real pickup there in M&A this year. So XLE, XOP, big winners there. Also, just from valuations, the cheapest sector in the S&P. And 10 years ago, these names are still down 10%, 10 to 30% from 10-year ago levels. So, and technically, you're talking about a real long-term bear market. And there's signs that we're coming out of the Great Bear into a new bull, and that's what we're looking for.
Let's dive deeper into that technical question. Matt, what do the charts show you here?
Well, it's kind of funny because we saw this incredible divergence develop between crude oil and the XLE. I can't remember one that was as wide as it was and lasted for as long as it did, almost 2 months. And now it's finally starting to see the XLE starting to pick up a little bit. And of course, with crude oil holding up, crude oil has only been below $60 on 3 days the whole year this year. And we have nice demand. The EIA just came out with raising their global demand for crude oil, and of course OPEC, which nobody thought they'd do, that they've kept with their production cuts, and Saudi Arabia is talking about $80 oil, et cetera. So if oil can hold up, you should see the XLE break out even more. I mean, it had been stuck in the sideways range. It's breaking meaningfully above that. But not only that, Exxon, which is by far the biggest weighting in XLE, it's 22% of the XLE, it was actually lagging the rest of the group. You can see 10, 12 stocks in the XLE that are broken out before Exxon has. So it's been a nice broad rally. And if Exxon, being the biggest percentage holder there, can break above its February highs and make a new high, that'll attract more momentum to that stock, which will bring more momentum to the XLE because of its extra strong rating. It'll take that even higher. So the whole thing can kind of snowball here. So on a technical basis, but divergence that developed a couple of months ago should resolve itself rather quickly with a nice, strong rally, a continued rally in the energy stocks.
We'll see if it happens.
And,
Matt,
and Sarah, I'd just add one last thing. You're talking about a late cycle. So people watching us right now at home, you've got to remember that in the first quarter, stocks and bonds were negative together for the first time in probably 7+ years. So your average investor sitting at home right now, getting their statements after that first quarter, was down in both stocks and bonds. And what happens in a late cycle is that the money has to go somewhere, and it's shifting. I believe this is a secular shift, a fantastic opportunity. The money's shifting in toward commodities. And that rotation is typically a late cycle rotation that's going through. It's more of a macro view, but we think it's in the early innings. It could last 2 to 3 years.
Well, certainly energy had been left behind. So you've got a point there. We'll leave it there. Thank you, guys. Matt and Larry, thanks for joining us.
Thank
you all for watching Trading Nation. I'm Sarah Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.